Well, good day, everyone, and thank you again for joining us for the Rock Apartment Transaction webinar. Today's topic is financing strategies in a low interest rate environment, and our guest speaker today is Rob Fleet from First National. We'll introduce Rob in a moment. So our upcoming seminar on December 19th is NOI Enhancement Strategies, and then January 30th we're going to do a recap of 2012 and some projections for 2013. Everyone who is on the webinar today will get a copy of this webinar recorded and all the slides. We know a lot of our fellow brokers join us on these calls. Welcome to all of you. Rock has a formal co-brokerage program, and if you're interested in the program, you can see the contact information there for Audrey Busbridge below, and Audrey will give you the details on how we work with other brokers. Just about 30% of the deals that we do at Rock are co-brokered. So today's topic, financing strategies in a low interest rate environment. We've got a terrific guest speaker. Good morning, Rob.
Morning, Derek. How you doing?
Good morning. I'm doing good, man. How you doing there?
Perfect. Thanks.
Good. So we've got a picture of you up on the screen there. How old is that picture? Is that recent?
That is a recent one, actually.
Okay, good. Well, you're looking good. Okay. So, Rob, thanks very much for joining us. And we'd like to just have you talk to our audience for a while just about what's going on in terms of financing apartments. I mean, it's an incredible environment, right? Right. And we've just got a series here of 10 or 12 slides that we're going to ask Rob to walk through. And then, so Rob, go ahead and take it away, please.
Yeah, okay. First of all, Derek, I'll just tell the listeners a little bit about First National.
Sure.
We've been around since 1988. Last week, we just surpassed $62 billion in mortgages under administration. And I think the key thing is that we are Canada's largest CMHC lender for multi-res properties out there in the country. So we have offices all across the country, and our transaction size ranges from $500,000 to $130 million. Okay.
And let me ask you a question. In terms of where do you personally work?
I work out of the Toronto office.
Right, but are you all over the country?
I'm all over the place. I do lots of business in Vancouver, tons of business actually in Vancouver.
And we have a number of listeners from BC. Great.
Yeah, most of my, we did Peter Cook and I financed the large Beach Towers deal a couple of years back. That was a huge transaction.
Yes.
We have a lot of great clients out there. So.
Okay, good. Next slide.
Yeah, I just thought I'd mention to your listeners as well that both Peter Cook, my partner, and I, we write a column in the Canadian Apartment Magazine, which you can access online or in print, and we call it Financing Made Easy. So I think we've written about 25 different articles, and you can access them all online, and they're all related to apartment building and apartment building financing issues. So.
Okay. So I like this quote from you, Rob. I'm going to read it. Okay.
Okay.
It's unlikely that we'll see increases in the next 6 to 12 months in the Bank of Canada rate. The global economy is still very fragile. Barring any unforeseeable, unmitigated disasters, we believe that interest rates will remain static and then rise steadily but slowly over time. I would think that's pretty good news for apartment owners, Rob.
Oh, definitely. Yeah, basically, money's on sale right now. That's what people need to know.
Right. But let me ask you, Rob, about an unforeseeable disaster, a war in the Middle East, the Straits of Hormuz blocked, the euro imploding. What would that do to interest rates? Would it keep them down longer, or would it make them rise, or do we just not know?
Well, when 9/11 happened and those sort of things, it's
sure.
To make them spike because everybody gets, it's bad news, right? So good news, makes them go down. Bad news makes the bond rates go up, and people get nervous, they overreact, or they get the knee-jerk reaction, and so everything goes up.
Okay, but barring any unforeseen problem, you're just seeing your company's kind of saying slow and steady increase in rates over time, but nothing jarring.
Exactly.
Okay, all right. Okay, so you're saying, all things being equal as best we can, a year out, interest rates aren't that different from what they are now?
Correct.
Okay, good, interesting, great. So next slide.
Yeah, so I just thought that I would speak to the listeners a little bit about what kinds, there's a lot of different investors that are out there, and they're all different kinds of investors. Some are conservative, some are really aggressive, some are short-term, some are long-term, some are the buy, hold, and never sell kind, some are turnaround experts, and some of them are developers. And each one of those investors really, requires a different strategy. And if we go to the next slide.
Okay, but I mean, each one of these almost could be a 5 or 10 minute discussion, couldn't it?
Oh, absolutely.
Yeah. Especially, I mean, the developer one, we do a lot of new construction financing. The short-term investor has to wonder whether he wants to pay the CMHC fees and things like that. Okay, great.
Really, big thing that we push is that your business plan should really dictate your strategy. What kind of investor are you? Going back to that last slide, where do you fit into that? And what is your business plan? What's your ultimate goal? And from there, we can help shape and help you with your strategy from a financing perspective.
Okay.
And the next slide that I've got here, just to clarify, there's different sources of funding. People can borrow money from chartered banks. They can borrow them from life insurance companies. They can borrow from mortgage-backed security lenders, which is what we are. They can also borrow privately. And I think it's important that people know there's a choice out there, and those are the main areas where people would borrow from.
Right. Okay, but when you're saying private lenders, for example, if I were an apartment owner and I wanted some mezzanine money or something like that, or I want to renovate my building, right? Mm-hmm. And do energy conservation work, is that the kind of financing that your company can do also?
Oh, absolutely. We do it all the time.
Okay.
Yeah, and I don't know if you want me to expand a little bit, but often there's some good equity in a building, and people, if they want, they can do like a CMHC insured mortgage, second mortgage on top of an existing first mortgage, regardless of whether that mortgage is a CMHC mortgage. The first mortgage is even a CMHC mortgage, and a lot of people don't know that. They can put a CMHC second. For instance, we could put a First National CMHC second mortgage on top of a Toronto Dominion Bank conventional first mortgage up to 85%. And the thing that most people really don't know is that CMHC second mortgage rates are almost exactly the same as first mortgage rates, which is really
wow. That's huge. That's huge. Good. But you also right. But you also do have money from private lenders?
Well, sometimes private lenders come into play when, like, we offer mezzanine financing on the right client, on the right deal, and if the client has the right background and experience, we'll often offer mezzanine financing from our company. Sometimes the deal could be, you're looking for a bridge financing to just get you to a better place.
Right.
And sometimes, the building doesn't quite qualify from a debt coverage ratio perspective. So what ends up happening is clients end up having to go to the private market where they're going to pay 9, 10, 11, 12%.
Yes.
But they do it kind of thinking that it's a sunk cost and that it's getting them to a better place.
Yes.
And so, oftentimes, they come into play, and they come into play on a deal where it's kind of tight,
Right. So basically you're saying like the majority of your business is CMHC insured, but you guys do some interesting things around that also to make deals work. Okay, great.
Oh,
good.
Absolutely, yeah.
Good. So let's go to the next slide on CMHC, because that's the majority of your business, right?
Yeah, I'll just say this, that between Peter Cook and myself, in the last 3 years, we've lent over $1.4 billion in CMHC financing. And it's important to note that, like, on the bottom of this slide, I've got 90% of all mortgages today for apartment buildings are insured through CMHC. And I'll give you some of the reasons why CMHC. So first point, CMHC insurance lowers the total cost of borrowing substantially. And jump in, Derek, if you want at any point here. I guess secondly, a big thing here is that you can finance up to 85% of the property value. You get lower interest rates. Over the past 40 years, it's important to note that CMHC interest rates have floated between 0.75 and 1.5% better than the next best conventional rate. So when you start, even if you look at a conservative number like 1% better over a 25-year term on a $5 million loan.
Oh, it's huge. It's huge.
Of money. And that's the main reason, you know, when you come up for renewal, there is no other costs involved. You just renew at that lower rate. You know, if you do five-year terms, you're renewing at that lower rate, and if history repeats itself, you're going to get between 3/4 of a point and 1.5 points better deal. And that is just a ton of money over time. So it's also important to note that you can extend the amortization out to 30 and sometimes 35.
I think, Rob, I would say this. I think the Canadian apartment industry is where it is today because of CMHC financing.
Well, absolutely. I mean, you know, without CMHC in the picture, I think it changes the you know, the whole landscape quite a bit.
Sure. I mean, I think during 2008 and 2009, during the recession, if you were a hotel owner, you couldn't find financing. If you had your CMHC ticket, there was a number of lenders there that were lined up to lend you the money.
Absolutely.
All right. Okay,
and
next slide.
If I could go back to that slide just for a quick sec, I think I missed a couple of key points. The other thing a lot of people don't know is with CMHC that it lowers your personal guarantees.
Yes.
So even if you do go to 85% financing, you're only personally signing for up to for 50% of the loan amount, and that's important because if you do a conventional deal, you're always signing up for 100%. Okay. And, you know, so that's an important thing. And I think the other big thing is that CMHC is available throughout Canada, even in the smallest nook and crannies.
Yes.
So if you're in a small little town with only 10,000 people, it is still available. And that's important for a lot of people. They don't know that.
Right. So their mandate is to house Canadians, whereas banks would say, look, we don't want to go to some small town in, you know, Northern Ontario. CMHC will go there. That's a really good point. Okay, let's go on the next slide, Rob.
Yeah, so I guess, you know, some of the other things just to sort of frame reasons to borrow now, and specifically now, I guess there's different reasons why people are borrowing money, and I'd like to highlight them. One is to obviously acquire a new property, okay? The second thing is, you know, and there's a few points to this, you know, people can unlock equity for down payments on a new acquisition. They can take an existing building that's free and clear, and they can basically put a mortgage on that at, you know, 5-year money today is under 2.5%.
Yes.
Take that money and use that money to acquire a new property. And so I would say that unlocking equity is one of the key things that we do for our clients. We're constantly doing that, and then we end up we do that mortgage, and then we do a new mortgage when they buy. The other thing is upgrading buildings, and let's face it, we've got an older inventory of buildings out there across Canada, most of them built in the 60s, 70s, and a lot of these buildings are getting old and tired, and they need capital expenditures, and they need greening initiatives, and they need to bring them back up to speed, and they need some money put back into them. So, you know, oftentimes we'll take a building, again, free and clear that's been there for 30, 35, 40 years. People will take out the money to do the deferred maintenance maybe that they've been putting off. These greening initiatives are more and more, you know, seeing more and more of them. People are investing in, you know, high efficiency boilers. They're investing in double pane thermal windows. They're investing in lighting, and all this stuff costs money. So rather than just write a check with after-tax dollars, we can put a small mortgage on the building at, you know, 2.5% financing, and they can write off the interest expense on that loan.
Okay, good, excellent, yeah, excellent, good. And what about estate planning?
Yeah, so, and then estate planning, you know, we've got a lot of clients, you know, we've got buildings that are second, third generation buildings, and they're paid off. And we've got clients out there that, you know, they might have a building that's worth $15 million and they have no debt on it. And so what they could do is, if they wanted to, they could put a $3 million mortgage on it, 2.5%, set that money aside in the estate, or they could hand that money to their family and watch them enjoy a little bit of the money before they pass away. So,
yeah,
you know,
good.
Those are all kind of things that we talk about. So, and I guess, you know, right now, you know, what should you do, I guess, in this environment? And in conclusion, it doesn't really matter what type of investor you are. It really is a great time to be in the apartment industry. Vacancy rates across Canada are like 2%. The interest rates are at like 2.5%. And, you know, it's important for everybody, that's listening to understand that apartment building rentals are the lowest risk asset class that any lender lends to.
It's a great time to be in the business, baby.
It's a great time to be in the business, and I think more importantly is please, consider taking advantage of these current economic conditions. I mean, basically money's on sale right now, and so if you're thinking of refinancing or acquiring or putting some money back in your buildings, now's the cheapest, time to do it.
Okay, good. So I put Rob's information up there, and everyone who's on the call will automatically get a copy of this presentation and this recording, and you'll receive all the slides also. Rob, that was terrific. Thank you. Rob, why don't you stay on while I do the recap of the apartment transactions?
Perfect.
Okay, good. Okay, so I want to thank RealTrack again for this information. RealTrack's contact information is up there. So in terms of the apartment sales this month, so far year to date, there have been 385 sales in Ontario. With 21,000 units being transacted, total sales about approaching $2.5 billion, and average unit price is $122,000. Rob, how many years have you been in this business?
7 years.
7 years. So when you started, average sale price was not $122,000, man.
No, definitely not.
Yeah, so things have really grown well. So the largest transaction this month was a property in Cambridge. I'll talk about that a little bit later on. Lena Crescent, $61 million. And the largest single price paid was, boy, this has to be a record, $414,000 per unit, but there were some factors behind it that we're going to explain to you in a moment. So in terms of the sales this month, 33 transactions, 20 of them were in the GTA, 1 in Hamilton, Niagara, 7 in southwestern Ontario, and 5 in Ottawa and in northern Ontario. So you can just see kind of the breakdown. And this changes a little bit month to month, but clearly the bulk of the deals, are in the Toronto area. So in terms of transactions, we always show a couple of these smaller deals here, Rob, right?
Yep.
So in this case here, we got a building. It's a mixed-use building. It was built in the 1920s. Selling just for an extraordinary price of about $1 million for 6 units and a little bit of commercial space. And we just see every month these smaller buildings selling for very, very strong prices. So here's a property, another property in Toronto. This is in the Black Creek and Lawrence area. Again, 10 units built in 1956, selling for $109,000 per unit.
Mm-hmm.
This was the really interesting one. This was a building that sold for just an extraordinary price of $414 million. But it wasn't that. This was basically a land play, and the property is zoned to develop an 8-story residential condo building. Okay, and I think this is something that we've just seen over time is that a lot of these apartment buildings are the land underneath the building, Rob, is worth a lot more than the building itself.
Right. Because
clearly here, this is not a $414,000 per unit building. It looks like a very ordinary building, but it's in a good area at Bloor Street West in Prince Edward. So this building sold in 2006 for almost $2 million. So in 2006, the units were not worth almost $200,000 either. Do you see my point, Rob? There was a land value there that's been known for many, many years, and more owners are now looking at the underlying land value in their building. The next building here is Oshawa. We've seen a number of transactions in Oshawa, and here's another deal in Oshawa at $90,000. I think the one we looked at last month was $100,000, $130,000. So even prices not just in Toronto but in areas outside the GTA are increasing quite dramatically. Here's a building on O'Connor. Again, maybe a more moderate price of about $86,000. This building sold in 2006 for $1.2 million and then resold for $1.5 million 4 years later. So sometimes you see dramatic increases in prices, and sometimes not so dramatic. Here were 2 properties that were sold at essentially the same time in North York in the Don Mills and Lawrence area, and you can see that these buildings sold for about $140,000 per unit. The next building here was on Vaughan Road, at Vaughan Road in the Vaughan and St. Clair area. Again, this sold for $120,000 $21,000 per unit, and that was a 42-unit building. I thought this building on Broadway was kind of interesting to look at. Broadway's, I think, a terrific location, you know, the Mount Pleasant and Eglinton area, and this building sold for $116,000 per unit. We think that, you know, Rob, a lot of the buildings in the Yonge and Eglinton area are absolutely ripe for repositioning and, you know, going in and gutting the apartments and raising the rents.
Absolutely.
This building on Valhalla, which is, you know, in the East Mall 427 area, this building sold for $140,000 per unit. But a year ago, in May 2011, this building sold for $9.9 million and just sold for $10.8 million. So in that 18-month period, it went from, you know, $129 per unit to $140,000 per unit. Another building on you know, in the same area there sold for $141,000 per unit. Now this was an interesting building here on Queens Avenue in Oakville. You know, if you read the ROC report, which we make available to all our listeners, that's a 72-page report on the Ontario apartment industry. Just go to our webpage, you can register to get it, and we'll mail it to you. But Rob, here's a building in Oakville that sold for $180,000 per unit.
Mm-hmm.
I mean, that's a big number. It was a right, but Oakville is a very strong market. The owner bought it in 1997 for $80,000 per unit, and you know, 15 years later, no, I'm sorry, yeah, about 15 years later, sold it for $185,000, more than double its value. Who says real estate doesn't make you money, eh?
Mm-hmm.
Okay. The next one is a building on Silver Spears in Mississauga in the Dixie and Burnhamthorpe area, and that sold for $151,000 per unit also. And here's one again in Hamilton. And again, look at Hamilton prices, right? It wasn't long ago that Hamilton prices were in the $30,000, $40,000, $50,000 per range, right? Last month we showed a building in Hamilton over $100,000. Here's a high-rise in the downtown core of $85,000, you know, per unit. Now, keep in mind that, you know, in Hamilton you typically get more real estate per pound because the rents are lower. The one-bedroom rents here are, you know, $715, and the two-bedroom rents are $815 per unit.
Yeah.
But I just would say that people are, I think, with prices getting this high, a lot more people are looking at Hamilton because, you know, in a nutshell, you get more dollars, you get more square footage per pound kind of thing in Hamilton than anywhere else.
Yeah, we're getting a lot of activity in Hamilton. A lot of our clients, I've done 4 very large deals north of 150 units
Right.
in the last 4 months. And we've got
Right.
2 other extremely large deals going down right now that we're working on with one of our clients. And
Right.
there's a real buzz around Hamilton. It seems.
Yeah, well, it's because, you know, maybe there's product available and you're getting more real estate for your dollar.
Yeah, and you can
Right.
still get a decent cap rate there.
Yeah, yeah. For now, anyways, you know.
For now.
Right. So here's a deal in Brantford, and you see in Brantford and places like that where the prices are a little more what they sort of used to be. You haven't had that rocketing price increase, right? So there's one deal in Brantford, and there's a second deal in Brantford again that sold for $65,000 per unit.
Mm-hmm.
Okay. Now the deal here in Windsor. Okay, and there again, you're getting more bang for your buck in Windsor. The rents here are you know, between $500 and, you know, $869 you know, per month, and this sold for $48,000 per unit. That looks like a nice little building for $48,000 per unit. You couldn't build it for 3 times that amount probably.
Yeah.
Here's another deal in Windsor. Again, this sold for $50,000 per unit, and rents are in the $625 to the $800 range. Here's another deal in Brantford, again selling for $91,000. That's got to be a pretty nice. That looks like a nice building.
That does look. It looks like all the needs have been redone.
Yeah. So you could think. So you're getting a lot of real estate. Here's an interesting one. This is a deal that we know actually a fair bit about. And this was a new tower built. There were 2 towers, and they sold for $227,000 per unit. So you take a town, you know, a small town like Cambridge. Cambridge has had 5 new apartment buildings built in Cambridge in the last 7-8 years, right? And all the buildings are full. all have been absorbed. And I keep saying this over and over again. There's lots of room to develop new apartment construction. So here's a new building built and leased up that sold for $227,000 per unit. And that was the biggest transaction this month. Here's a property in the Ottawa area that sold for, I don't know if you know Ottawa at all, Rob, but Vanier, it's not the best part of Ottawa. Right, but again, this sold for $106,000. And I think this was a combined sale, so sometimes when there's a combined sale, it's difficult to figure the average price per unit, so maybe they've been divided, you know, just arbitrarily as opposed to the value of the property. Right, there's another one that was part of the same transaction for $109,000 per unit. And then here's another one, and then here's the last one, selling for $109,000 per unit again. Another building in the Ottawa area, again, a high-rise building selling for $85,000. Again, that looks like a very reasonable price, but it's part of that same transaction. So, you know, we saw a frame building there selling for $109, Rob, and a high-rise selling for $85. And so maybe it's, it just depends on the scenario. And this is the last building that occurred in that same. Actually, this is the last building that occurred in that same multi-leg transaction. So there were a number of deals we pulled out. About half of the deals that occurred in the month to share with you because we thought they were interesting. If you have any feedback for us, we'd love to get an email from you. We're just going to be setting up all our topics for next year. So there's a particular topic that you want to have us visit. And we like to do sort of, different topics than are normally heard out there in the marketplace. We're delighted to get some feedback from you. Keep in mind our next seminar is coming up on December 19th, and that's on NOI enhancement strategies. If you would like to sign up for the next webinar, just go to our webpage right there and click in on the free webinar, and then you can choose the webinar that you would like to attend.